I can easily see it going to $10,000, but that's not even a stretch. That's pretty straightforward. $25,000 or higher, yes. But let me give you some concrete math and analysis behind that, because anybody can throw out a big number, and they're out there, they're on podcasts or whatever. It's gold 25,000. But you need to know why. And there are a couple things in play here. Number one, in January 1971, gold was $35 an ounce. In January 1980, it was $800 an ounce. That's a 2,700% increase in 9 years. If that happened again, I'm not forecasting this. I'm just saying it happened. And if it happened again, gold would be $100,000 an ounce.
While a target of $10,000 for gold is often viewed as a psychological ceiling, new analysis suggests this figure is merely a baseline, not even a stretch, rather than a peak. Historical data indicate that a repeat of the 1970s bull market could push prices to levels that seem unfathomable to the average investor today. Jim Rickards, a renowned economist and investment banker, provides the concrete math backing these explosive targets. He dismisses the idea of arbitrarily throwing out big numbers, instead grounding his forecast in the complex data of the 1971 and 1980 era. Rickards notes that gold surged from $35 to $800 in just 9 years, a staggering 2,700% increase. He argues that while $10,000 is straightforward, applying that same historical percentage increase to today's market doesn't just point to $25,000, it mathematically implies a price of $100,000 per ounce if the cycle repeats. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is going to go a lot higher. And I get a form of that question a lot, Julia, because people say, hey, Jim, you said to buy gold when it was $1,200 or $1,300. I should have listened to you. I didn't. It's getting close to $5,000. I missed the boat. And my answer is, no, you missed $3,000 or $4,000, but you didn't miss the boat. This has much further to run. And it's not a top. It's nowhere near a top. And it's going to go, well, I can easily see it going to $10,000, but that's not even a stretch. That's pretty straightforward. $25,000 or higher, yes. But let me give you some concrete math and analysis behind that, because anybody can throw out a big number, and they're out there, but you need to know why. And there are a couple things in play here. Number one, in January 1971, gold was $35 an ounce. In January 1980, it was $800 an ounce. That's a 2,700% increase in 9 years. If that happened again, I'm not forecasting this. I'm just saying it happened. And if it happened again, gold would be $100,000 an ounce. When gold goes from $35 an ounce to $800 an ounce, which it did, you can say, oh, the price of gold went up. Yeah. But if you hold gold as your constant, in other words, what's the dollar worth by weight of gold? Don't ask what gold is worth in dollars. Ask what the dollar's worth by weight of gold. It's just the inverse.
Okay.
The same math. The answer is that was a 94% devaluation of the dollar. The dollar lost 94% of its value measured by weight of gold. And people today are looking around like, hey, the dollar's going to, it's the crack up of the dollar's going to collapse, et cetera. But they look at the currency market. That's not the right way to think about it, because all these currencies are in the same boat. For example, what's a euro worth in dollars? That's the question. The answer is about $1.16. So 1 euro equals $1.16. Guess what the euro was worth in the year 2000 when it was first issued? $1.16. In other words, it hasn't changed in 25 years. Now, it's gone up and down. It was $1.60. It was 80 cents. It fluctuates. There's volatility. You can make or lose money. I'm not saying it's constant. It's not. But the fact is, there's no collapse of the dollar there. The euro dollar cross rate today is exactly where it was 25 years ago. That's not where you're going to see the collapse. It's not going to be in the currency market. It's going to be in the gold market. And so when people say the price of gold goes up, I get it. But if you have a gold coin, you put it in a drawer and you close it and you go away for a year and you come back and you open the drawer, it's still a gold coin. It didn't multiply. It didn't do anything. The gold is the constant. It's the value of the dollar that's going down. Okay. So when the dollar price of gold goes up, the way I think about it, the U.S. dollar is collapsing.
The purchasing power of it.
Of the dollar in terms of weight of gold.
Oh,
that's the right way to think about it.
That is so fascinating. Okay.
So with that in mind, using that as a metric, when did the dollar collapse? So in the 1970s, in gold, it lost about 94% of its value. If that happened again, I'm not saying it will, but if it does, gold would be $100,000 an ounce. So if I say $100,000 an ounce, people are like, oh, Jim, you're crazy. What are you talking about? And my answer is, it happened before.
Right.
Okay. Now, there's another phenomena, a little more down to earth, and we'll tap into behavioral psychology. Because in behavioral psychology, there's a big science, Daniel Kahneman and Tversky and Dan Ariely and a few other leaders in this field. And they've identified a whole list of biases. We're just human. We have biases and instincts, and we can't get rid of them, but it's good to know what they are. But one of them is called anchoring. And anchoring means we get a number in our head, we get an idea in our head, and we can't get rid of it. And we begin to filter everything we see through that idea. That affects everything we think. So as applied to gold. So let's just say you have 50 ounces of gold and it goes up $1,000 an ounce. You just made $50,000. I mean, that's real. It goes up another $1,000 an ounce. You just made another $50,000. And so on. Every time it goes up $1,000 an ounce, you made another $50,000. Well, but you kind of get anchored on the $1,000 jump and the 50 ounces and the $50,000. But what people lose sight of is that each $1,000 leap is easier than the one before, a lot easier. So for example, when gold went from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a heavy lift. And from 3,000 to 4,000, that's a 33% increase. That's still a big lift. Now we're at 5,000. But when you go from 9,000 to 10,000, that's only 11% because you're working off a much higher base.
I see what you mean, yeah.
And when you go from 19,000 to 20,000, that's only a little over 5%. So the point being, these $1,000 leaps get easier because you're working off a higher base. So what's going to happen? Gold's, it's made its way to 5,000, not quite there yet, but it'll be there, very shortly. And it's going to, take a while to get to 6, but it's going to go 7, 8, 9, 10 really fast for the reason I just mentioned.
Gold's current rally is viewed by many as nearing a top, but historical analysis suggests we may be only at the initial phase of a much larger repricing. Financial models using 1970s bull market data indicate that if the dollar's devaluation cycle repeats, targets of $100,000 per ounce are mathematically plausible. Expert commentary emphasizes that the 2,700% surge from 1971 to 1980, where gold rose from $35 to $800, actually represented a 94% collapse in the dollar's purchasing power, a reality often hidden by stagnant currency cross rates like the euro or dollar. The analysis further notes that anchoring bias creates a psychological barrier for investors, obscuring the fact that as the base price rises, massive $1,000 leaps require significantly less percentage effort. Consequently, hitting benchmarks like $10,000 or $25,000 becomes a mathematical inevitability rather than a speculative stretch as the currency continues to lose value against tangible assets. Let's get back to the interview.
The effort to freeze and steal the Russian assets has given a reason to countries around the world to say, well, what else are you going to do? And the problem is there aren't many alternatives. Like if you don't like treasuries, do you want to buy Italian debt, Japanese debt, German, maybe? Those markets aren't that big, by the way. They're Italy, Japan, and Germany are like the second, third, and fourth largest sovereign debt markets after the United States, but they're nowhere close to what the United States has. And Italy, we have to tell you this, they're not famous for fiscal prudence. Japan's debt, we talked earlier about debt to GDP ratios. I said the U.S. was all-time high at about 125%. Japan is 300%. So you're rushing into JGBs? I don't think so. But gold is an alternative. And so this is another driver of gold. And then finally, people fear inflation. We're not going to get inflation. We're going to get deflation.
But gold does well in both environments. I learned that in your book.
That's correct. And that's another thing that people don't really understand very well because they think of it as an inflation hedge, and it can be an inflation hedge. The correlation is a little lower than people realize, but at the margin, yeah, gold is a decent inflation hedge. But gold does very well in deflation. In the Great Depression, 1929 to 1933, well, lasted longer, but just take that period, the worst part of the Depression. It was the longest sustained period of deflation in U.S. economic history, and gold went up 75%. It went from $20.67 an ounce to $35 an ounce. It was an almost 75% increase in a period of deflation. And there are complicated reasons for that, having to do with the fact that, people say inflation favors the creditor. Inflation favors the debtor and hurts the creditor. So you lend me money and we have a lot of inflation. And I say, hey, Julie, here's your money back. Good luck buying a loaf of bread. It's not worth very much.
Yeah.
So the debtor wins in inflation because I get to pay you back in cheaper dollars. In deflation, it's the opposite. The creditor wins. So you lend me money, prices go down. When prices go down, the value of the dollar goes up. You can buy more stuff for the same dollar. So as a debtor, this becomes more and more onerous. You're sitting there saying, hey, my loan is worth more in real terms because of deflation. But I'm sitting there saying, I got to pay Julia back more in real terms. And that lasts for a while. But then what happens is I walk away. The debtors default. And I'm like, sorry, Julia, see you later. I'm going to get it. I'm filing for bankruptcy. I'm going to sleep in tomorrow and good luck. So what happens is the debt goes from the original debtor, who then just goes bankrupt and walks away, to the bank that you basically, if you're the bank that lent me the money and I walk away, now all of a sudden you don't have a higher real value loan. You have a bad debt. And this erodes your capital and you're going to lend less. This is how you get into a depressionary cycle. So in that world, people look for something that's not going to lose value. The best performing stock on the New York Stock Exchange from 1929 to 1933 was Homestake Mining. Homestake Mining was the largest gold mine in the world. Foundation of the Hearst family fortune, by the way. Huh. So William Randolph Hearst III or whoever was around.
I did not know that.
Yeah, George Hearst found the mine with some partners in the late 19th century. He either bought out or killed his partners, kind of ruthless guy, but he ended up with the whole mine. But it was the largest gold mine in the world for a long period of time. But this was in 2009. And we did a scenario where Russia and China pooled their gold, came out with a new gold-backed currency, said, we'll only sell you our manufactured goods or natural resources in that currency, which forces everyone to get gold to get the currency, et cetera. Now, nobody thought that would happen overnight. The whole idea of a war game is to look 5 or 10 years ahead. And we did. And actually, Secretary Gates, Robert Gates, who was Secretary of Defense at the time, looked at the results and said, nice going. You people did a really good job on this. But my point is, when me and a friend of mine and a couple others, we proposed this in the middle of the war game, we were ridiculed. People laughed at the Harvard professor types and the think tank types. Like, you're wasting our time. Why are you talking about gold? Gold's not money. It plays no role in the financial system, et cetera. And we're like, let's bear with it. Let's see how it plays out. Since then, this is 2009. In 2009, Russia had 600 metric tons of gold. Today, they have about 2,800 metric tons. China had 600 metric tons. They also have close to 3,000 metric tons, probably more that they haven't disclosed, maybe double that amount, but at least 3,000 on the books. In other words, Russia and China have done in the last 17 years, they've done exactly what we told the Pentagon they would do at the time, which is they've accumulated gold. And by the way, why we talked about sanctions on Russia and freezing these assets. Why is the Russian ruble stronger today than it was when the war started in 2022? Remember, Biden's like, the ruble will be rubble, we'll crush the ruble, we'll crush the Russian economy, et cetera. Sorry, Russian economy has outperformed the U.S. economy. The Russian ruble is stronger today than it was in 2022. Russia's financially sound. How did they do that? Well, going back to what I said, going back to 2009, the head of the Russian central bank is a lady named Elvira Nabiullina. And I always say she's the only central banker in the world who understands her job. But she put 25% of Russia's reserves in gold, physical bullion stored in Russia. So at the time, meaning 2022, Russia had about $600 billion in reserves, but $150 billion of that, or 25%, was in solid physical gold bullion. And the U.S. couldn't steal that. We couldn't freeze it because you can't freeze physical bullion. It's there. And so that gave the world a lot of confidence. Like, yeah, okay, you froze Russia's U.S. treasuries, but you got gold and you have other assets and you have natural resources. So they were financially sound. And the irony is that the sanctions, including freezing the Russian assets, are part of what drove the world to buy more gold. And Russia has made more money on their gold reserves than they lost on the treasuries.
That is an irony.
They've made over $200 billion mark-to-market profits on the gold while we're stealing $200 billion in treasuries. They've made more than that on gold. But the U.S. caused it by creating doubt in the treasury market, which says, okay, well, then I'll buy some gold. So again, as you said earlier, it's all connected.
The seizure of Russian assets has accelerated a global pivot away from U.S. treasuries, yet few viable sovereign alternatives exist. Japan's debt-to-GDP ratio sits at 300%, while Italy remains fiscally precarious. This lack of safe harbors has established gold as the primary beneficiary, driving prices higher. Contrary to the popular inflation-only narrative, historical data confirms gold is an exceptional deflationary hedge. During the Great Depression's deflationary spiral, 1929 to 1933, gold purchasing power surged 75%, and homestake mining became the top-performing stock on the NYSE. Russia's resilience under sanctions further validates this thesis. Central Bank Governor Elvira Nabiullina allocated 25% of reserves to domestically stored physical bullion, assets immune to Western sanctions. Ironically, the profits from this gold appreciation have exceeded the losses from seized treasuries, proving that physical possession of neutral reserve assets is the only proper protection against geopolitical weaponization. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.